So the big thing I want to talk about this week is the whole Pac-Man analogy and how we could have used it this week to frame a trade where the market might have wanted to go in terms of direction and everything like that.
Okay.
So this is a 4-hour chart. So every candle is 4 hours of time.
Right.
These the market essentially on Sunday last week it opened up here basically at this red line. So if we were to look, we need to remember that Pac-Man can only move forward and he can only look backwards. It cannot use, new data points that are past this red line. It can only look back at old data points that already exist and were printed. So when we're, say, for example, here and the market opens, everything past that red line doesn't exist and isn't there yet. So we can only use old reference points that are in this screen right here as
Where they
places.
look, where they look, the reference points. Do you know where they are in here?
So the market will use a couple different ones. It'll use either inefficient ones, like the fair value gap, the order block, all of that kind of stuff,
Yeah.
or it'll use the stop losses, the old highs and lows where people have their stop losses. Those are like the two big spots. Because remember, Pac-Man, he's going to go for either the big dots, which are the stop losses, or the little dots, which are those inefficiencies. So when we're here at around 15,800, if we look backwards, ideally 60 bars at what the market can go for, it's this far about. Because the market basically always looks back 60 bars is like the whole speech behind it, essentially. So if we're going to look at, if we're going to look at this range from here to here, what are some places that the market can use? So we obviously have this high up here. We have this low down here and a couple lows down here. As like the two obvious highs and lows.
Right.
There's not really that many inefficient spots. So for example, the fair value gap here, candles low, candles high, it got filled right here. So this is good. This sell side, this bearish fair value gap is good. But if you look, it left a couple of bullish ones. So when you're looking at areas that the market can go fix, and I guess there's one here that it tapped into when the market first opened. So there's a couple different spots that the market can go to frame and use as quote unquote reference points. And it's going to be those inefficiencies and those stop losses. So when you're looking at market open and you're looking back, 60 bars from whatever time frame you're on, we have these lows down here, these two fair value gaps here, and then we obviously have this high and this one here, this fair value gap. It's getting touched right when the market opens, but it's still there. So we need to recognize that anything past this red line here doesn't exist yet. It hasn't printed yet. This is Sunday, right when the market opens at 6 o'clock. So Monday, Tuesday, Wednesday, Thursday, all that, those days haven't printed yet. They don't exist. So the reason that is so important is we need to understand that the market is only going to use old data points. It cannot use new ones that are created after this red line. It can only use old ones that are already made. So as the market opens and it starts to trade and everything like that, these yellow lines denote the weekly candle. So for example, if you go to a weekly chart, it was the previous week's high was right here. The previous week's low was right here on this candle. This was obviously this week. This is last week. So the previous high and low is that yellow line. So I'll get rid of this. So when you're trading and you're taking out the previous week's high very, very early in the week, you generally want to look at the other end of the range for the market to trade towards. Now, the reason that is
Right.
so important is because we took out the weekly. So there's 5 days in a week, right? Monday through Friday. Not trading. In trading, there's 5 days, not actual, calendar week, but there's 5 trading days in a week, Monday through Friday. 5 business days, if you want to call it that. So if you're on business day one already and you took out the weekly high, you should expect to spend the rest of the days going towards that weekly low. And when you tie that into our old reference points, which were down here as possibilities and these two fair value gaps, we know that Pac-Man is going to seek inefficiencies, so these two fair value gaps, and then stop losses, aka these equal lows down here. So the idea is that should be our main area that we're moving towards in the market. With that said, we also need to recognize that, say we get a long setup or a bullish setup past this red line, anything in here that may have looked bullish, like this candle here, is going to look bullish on a smaller time frame when we look into it. They're all going to be fake. And we should expect that none of these long setups to work, because the market isn't using these as reference points. It's using these that were previously existing. It can never use current data because the candles weren't printed yet.
Right.
Like when we're here on Tuesday, for example, Tuesday is after Sunday. So
Right.
if we're looking backwards from Sunday, Tuesday hasn't happened yet. So we cannot use candles that were made on Tuesday. We have to use what was already there prior, because we're looking backwards to move forward, is the whole idea. So when Pac-Man's up here and Pac-Man is price, all he sees is that corner of the board where there's some stop losses and some extra dots. That's all he's going to go for. Just like when we're playing the game Pac-Man and we clear that corner of the board and it's all gone.
Yeah.
We don't care about it. We stop worrying about that board, and what do? We collect the dots at the rest of the board and keep doing that until we repeat and go to the next level and do it again. So it's the exact same idea here. When we're here, all we're still seeing are these lows down here to go for. That's it. That's all we're looking back at and moving towards. So we know that any long setup or things like that we get are fake until we actually run for that low or wherever reference point we're using to look backwards at, is the idea.
Okay.
Now what's cool is you can use the look back range from any candle that you want. Meaning, let's say we're looking at this Thursday candle here. If we're looking backwards, we can get rid of this. If we're looking backwards from this candle now, what do we see here? We still have we have all of these candles now, we can all use them. When we were coming from the Sunday line here, we can't use these because it's ahead of it. So it doesn't exist. But if your look back point is from a different spot, you can use everything and before that. You just can't use stuff after, is what it is.
Right.
So when we're here, and say, for example, we're running this low here, what is that going to do? That's going to trigger a lot of stop losses, a lot of sell side stop losses. It's going to force everyone to sell at a really, really low price. Because people were already selling once these lows were taken here. Because their stop loss was hit, and now they're all sell to close. So once it does that again, it's making people sell to close at a very, very low price. And if you look at just this chart here, only between this red line and this red line, and we look at what is inefficient, there's really not that much. Meaning, we know that buy side and sell side offered at a certain price level, once it does that multiple times and makes that paint analogy, it's balanced.
What paint analogy? I thought we only did the Pac-Man analogy.
Yeah, so you could, there's like two different ones you can use. So ideally, with the paint analogy, so let's say we're at 16,000 here, and down close candles are going to offer, sell side, and up close candles are going to offer buy side. So when we're at say 16,000, what is it doing? Because remember, the market can't teleport. It has to go through every single limit order that exists in that price range before it can move to the next one. So let's say we offer sell side at 16,000. We'll do it in white. And we offer buy side at that same price point. So if you think of a paint analogy, like where you're painting a wall, you do the stroke down, the stroke up, and so you're kind of painting that area twice, and then it leaves it on the third stroke out. Is the idea.
Gotcha.
Because you can't have only buy side delivery. That's what a fair value gap is. Like this right here. These two candles here, these are both, the bearish fair value gaps. Right? So if you think about it with that paint analogy, that's one stroke down. One big stroke down right there on these two candles. So what does it need if it had a big stroke down? It needs a big stroke up. It needs buy side offered at those same price levels. And that's why the market fixes these eventually. It fixes this lower one relatively quickly, a few candles later. But this larger one up here gets fixed on Thursday. But it still gets fixed. That's the whole idea.
All right.
So even on this one right here, this large bearish one, think about it. The paint was just stroking down. How do you repaint that to fix it? You put buy side up on that area. You do the stroke up. So if we're looking at this right here, and we're going to look at this actual price range from the 15,900. We see it offered sell side, offered buy side, offered some sell side, offered buy side to fix this sell side to fix the buy side. You can see there's a fair value gap in here.
Yeah.
Candles low, candles high, fair value gap here. It comes into here to fix it, and then continues. And then we can see an actual gap here, like a real gap. You can see it comes in to fix it there also. So all of this up here is good and it's balanced. So Pac-Man doesn't see it. We see it because we have candlesticks on our screen. But Pac-Man does not see it. Because Pac-Man already collected all the dots here. So that corner of the board is cleared out. He has no reason to be there.
He can't look back either.
Correct.
He turns.
He's not looking back at that. He's looking back at other stuff. Because remember, we're looking back from this line, from this red line here, and left. So when you're doing that, once you find your look back point where you want to start from, you then go find where is it inefficient, what needs to be fixed, and all that jazz. So if we're looking at this here, we start the look back from here, and then we go look at what's inefficient. So because all of these candles are offering buy side and sell side at the same price, this 15.9 to like 15.8, whatever this is, it's all balanced. So it doesn't see it at all. It's invisible to it. So Pac-Man doesn't see any of this right now. It's all gone. You can see this candle here offers sell side on the wick and then buy side when it trades back up. This one comes up, comes down, and then this candle here trades down. Offers buy side to fix this as it breaks it. And then you can see the large fair value gap that's right here on this candle.
All right.
So when we're really looking at when we're looking at what Pac-Man has to go for still and fix, if we know that all of this is balanced because it offered sell side, buy side, sell side, and everything like that, all Pac-Man sees is this fair value gap here. That's all he sees. All of this is efficient. He's already collected the dots he needs. The paintbrush has already ran through this multiple times. It's all good. It's all good and fine. Like I said, we only see it because we have candlesticks on our screen, but Pac-Man does not see this. And that's what's so key. So when we're looking back from, again, this red line here, all he sees is this right here to go for. That's all he wants to go seek and fix. So when you're looking at something like on a Thursday and there's only, a day and a half left of the week because you have, half a Thursday and Friday, that's the only time that's allowed left for Pac-Man. So when you're going into Thursday and Friday, you can expect him to fix that area, and you can see that's what he does here.
Yeah.
Clean some of these out. A lot of drawings for no reason. But you can see that this fair value gap we were just talking about, it fixes it on Friday. It fixes all of it. And then it keeps going down and continues. So when you're looking at I'm trying to think how to explain it. When you're looking at what is inefficient and what needs to be fixed, this is essentially what you're doing. Is you're picking a candle. You can pick literally any candle you want. That's the cool part. You can pick any candle you want to look backwards from. And your range is going to be about 60 candlesticks, whatever time frame. And you can do this on every time frame also. Just like how the market maker models, how we look at it, on a 5-minute chart versus a 1-hour chart versus like a 4-hour chart like this, it's all still the same idea. The only difference is the candlestick duration. So, like I said, when we're looking back from here, all Pac-Man sees is this inefficiency. So that's what he goes to fix, because all of this up here is balanced. He doesn't need to come back here anymore. So that's what it goes to fix here. And again, it's just a fair value gap that it went to fix, because the fair value gap is that large paintbrush stroke up or down in one direction only. So it needs a paintbrush stroke in the other direction to balance it. And then it'll do that final stroke out to leave it. Because remember, it can't teleport. So when it's up here, it can't just instantly teleport down here and go from A to B. It has to walk its way down there to get there.
All right.
So now if we're going to look at something like right now, say we're going to look back from here, and we want to do the exact same thing. If we're going to look at, 60 bars, for example. About 60 right here. We pretty much took everything out on this time frame. It's all balanced and it's good, so there's not really much. Which means, because you can do all of this fractally, it's looking at something on a higher time frame. That's higher than the 4-hour. If the 4-hour is good and the 4-hour is fine and dandy, it's looking at something else. That's on a larger scale. So it could be on something, say, like a daily chart. And you can do the exact same thing. You can count back, 60 bars. The idea is to do it 20, 40, and 60 is what you're supposed to do. But 60 is like the maximum range. So you're looking at anything within 60 more so is what it is. So if we're looking at that, actually, let me pull up TradingView because it does it automatically. It'll look a lot nicer. So this indicator, it just draws it for me. But you can see the exact same thing. So like the 60 bar range, there isn't a whole lot. This fair value gap that we talked about first was fixed and it's good. So that's not going to be there anymore. So we can look at something like a daily chart. And what you'll do is you'll look back 20, 40, and 60 days and see what is inefficient and needs to be fixed. So we can see on the daily chart, there's this large fair value gap here. It's denoted by this box for us also, so it kind of drew it for us, which is nice. So the market could very easily be seeking this to go fix, and this one right below it. So this is what the market is probably going to move towards, and it can also just move towards this low in general. Is really where it really should go for this low. Why this low? So, like I said, the 60 bar range is just the maximum range, but you really want to do 20, 40, and 60 is what you want to do. So you want to look at 20 bars backwards, see what there is, then look 40 bars backwards, see what there is, and then look 60 bars backwards and see what there is. Is really what you're trying to do. So we'll start looking at, it says IPDA 20, so we're going to start from this candle and look back 20 and see what there is. So there's the two fair value gaps that we mentioned, and then this low down here. The market does not need to come up to these highs yet. It might in the future, but it doesn't need to right now. The market is currently at a premium. Well, it was at a premium. Meaning if you take the high and the low with, I'll show you eventually, Fibonacci tool, you'll be able to show what is considered premium and what is considered discount pricing for Pac-Man to use. So ideally, you want to look for longs when it's cheap. Just like you go to the grocery store and you want to buy something when it's on sale. It's the same idea with this. You want to buy the market, the NASDAQ or whatever it is, when it's cheap. You don't want to buy it when it's super expensive. You want to sell when it's super expensive, but you don't want to buy it when it's expensive. And it's the same thing the other way around. You wouldn't want to sell it when it's super cheap. You'd only want to sell it when it's super premium and super high priced. And that's just back to economic 102. Like if you think very, very basic, you want to buy something when it's you'd rather buy something for $15 versus $20 if you could, right? It would just literally be cheaper to get the same thing, so why would you not want to buy it at 15?
Sure.
It's the same thing for selling, just the opposite. Because a lot of this stuff is just inverse of each other, one-to-one, but it's still the same idea. So what you're seeing in, for example, just this box here, you can see how this upper area is shaded purple and this area down here is shaded green. Ish, blue, green, whatever color you want to call it. That is showing the middle line is essentially the 50% or the equilibrium of the range that we're in right now. Like the daily chart on the NASDAQ is in this range for the 20 bars. For the last 20 days, it's in this range. So when we're up here, like I said, on Tuesday, Wednesday, and everything like that, we're well into the premium. So we don't want to be looking for longs in the premium. We want to be looking for sells, which is what we were tying back to on our 4-hour chart. When we're looking back from, the market officially opening, here, or no, like whenever it was opening here, if we know that we're in a premium from this low to this high, we're well above the 50% mark. So we really only want to be looking for sells. Now, is that in a vacuum going to save you? Sometimes no, you're going to want to buy it in the premium and sell in the discount. However, what we're really doing with all of this is pairing everything together. So not only are we taking the premium discount, we're also doing the look back, like I said, from whatever candle you want to do from, and how we were referencing these old lows here first when the week first opened, and the previous week's high was taken very, very early. When you're able to combine multiple things like that together, and they're all kind of pointing in the direction that you want to be shorting, you have a very, very high chance that that's what is going to end up happening, what you want to do. So it's more so like pieces of a puzzle you're putting together to come to a conclusion. But you're doing all of it with logic and reasoning, and not just for whatever reason you feel like, and that's the big difference. So you should be able to at least know on occasion hey, I'm in the premium. If I get a long setup, I probably shouldn't take it. And if I get a short setup, I should be more inclined to take it. And then you also know that, let's say you don't get any short setup, like you get no short setup and you're in the premium, you know that it's best to just sit out and wait. You don't have to trade ever. And that was
Yeah.
kind of like to the whole week 2 thing. You can't force anybody to enter. You can force people to get out because you hit their stop loss, but you cannot force people to enter. So you have all the power in the world to which if you don't want to enter a trade, you don't have to.
Is there a way to avoid people entering your messing with your stop loss so you'll have to leave?
No, there's none. The market can do whatever it wants to do, and you have to accept that risk.
So if it happens to you, you're just unlucky.
Correct. Sometimes. Sometimes you can take bad trades, but ideally, if you're taking a good, proper trade, it will be, yes, just unlucky. And that's all it is. You are essentially. Have you ever played like a slot machine?
Yeah.
You are literally hitting a slot machine. This is no different than that at all. Just like how when you hit a slot machine, you have no expectations. You're just expecting something to happen.
Yeah.
You want the exact same thing with your trading. You don't want to be worried about, am I going to be right? Is it actually going to happen? You just need to hit the button. If the time calls for you to hit the button, all you can ask is to hit the button. The rest of it is out of your control. Because just like the slot machine, when you hit the slot machine, the machine determines if you win or lose, not you.
Yeah, you're at the machine's mercy, which is basically just luck, 50-50.
Correct. So it's the exact same thing with the market. You and me do not control the market whatsoever. We are at complete mercy of what it does. So there's nothing we can do in that regard to stop anything from happening. We just have to accept it, and like I said, it's at their we're at their mercy. We are always going to be at its mercy, no matter what.
High risk, high reward.
Correct in that regards. So when you have something like that, now granted, you can wait for, if you're expecting someone's stop loss to get hit, which for example, some equal lows like these, how there's like 3-4 in a row right here, 1 2 3 4. That's a very, very common area for the market to get ran and like get traded through and the stop losses get hit. That was the reason I started off with that and fair value gaps, is they're probably the two easiest things to see in the market, truthfully. Because the fair value gaps are usually those large, big candles like these that are really, really large. And then the equal highs and lows where you can just see, oh, the market hit this area, 2, 3, 4 times. That should be relatively easy to spot. Same thing up here. You can see the market hit this area, 5, 6, 7, 8 times up here. So there's equal highs up here. So eventually the market could go for this, but for right now we need to look at what does it want. And right now the algorithm, because we know this area is balanced up here, because it offered the sell side, buy side, and everything like that, we're not looking up there right now. Because remember, we can only look backwards at old data.
Okay.
So, and if you think about it, because you can do this look back from anywhere. So let's say we're looking back from here, from this high all the way up here.
Right.
All of this, anything here doesn't exist yet. All we can use are these old reference points here as areas where the market can go for. So what do we have? We have a fair value gap here, all the way up here. This one here got tapped here, so we're not going to use that. There's one right here. There's one right here. And then there's not really much else besides the old low itself. Like I said, that's what's so cool is you can look back from literally anywhere. And you can get a very, very good idea of where the market will want to go back and fix when you're doing it from the higher low that the market came from. So if the market came from this high all the way up here and you look backwards, you know that all of this here is fake.
Right.
and the market only sees all this stuff here. Now again, if we're going to look back from, say, this red line here, the second one, then yes, all of this stuff is real, and now it exists. And if we're going to look back from this red line, then yes, all of this stuff now exists. However, when you're picking the one that you're starting from, anything ahead of that doesn't exist yet. So it's not used as a reference point. So when we're like here on this first red line, and we saw all those fair value gaps, we can see the first one got hit here. It got hit relatively quickly. The second one here, it got hit here. The third one down here, it almost got hit. It hasn't got hit yet. But that's what we can expect the market to move towards. So we should ideally realize that anything that we get as a long setup past this red line is not going to work. It might work for a little bit for like, a 1-day trade or anything like that to, fix like a bearish fair value gap like this one. But we should not expect it to be a full-blown continuation to go higher or anything like that either. We should expect the market to, again, it can only use old data points. Because if we're here on Wednesday the 19th of July, anything past this doesn't exist yet, so we can't use it. We can only use here to here.
Right.
This is all Pac-Man is going to reference is this stuff here. So if we're expecting to fix, these inefficiencies and then hit the final dot down here, well, we should know that any push away that's like this one here or this one here, it should eventually turn around and come down to here because this is what it was originally referring to. And this is the whole idea of the look back. But a lot of people, and I mean a very, very large sum, this is how people get trapped because they're not looking back at what the market can use as old data. They will use the new data, for example, like this stuff here, that's past the red line, or they'll use like these candles and think, oh, I'm getting a bullish setup in here, and they'll take it long, but they're going to get stopped out because the market's not looking to go long, it's actually looking to go short because it's still looking at, for example, these lows here. It's only going to reference old data. So when you know that you're referencing old data and the market, for example, in this case, is referencing lows, you know that anything that is pointing in the direction of going up should not work. So I'll say that again. If you're referencing old lows, anything that's setting you up to go long/up, you should expect to be fake. And it's the exact same thing on like even a smaller time frame because I can actually show you what happened to me on Friday. So, because I fell for the...
Was it bad?
No, I just took a loss, but for the exact same reason I'm telling you about right now. Because I made the mistake that, like I said, a lot of people make, I made on Friday. So let's get rid of this. So market was here. It was around 11 o'clock, basically. You can see the market took this low out here, right?
Yeah.
Now let's do the exact same thing because we can do that. Because remember, we can look back on any time frame and we can do the exact same thing. So let's look back from this low here, and then we'll look back 60. We're just going to do it on a 5-minute chart instead of a 4-hour. That is the only difference. No, all the logic, everything else is going to be the exact same process. The only difference is this is on a 5-minute chart and not a 4-hour. That's it. I want to make that very, very clear. That's the only difference whatsoever. So, from here, and anything within this range, we can look backwards and what do we see? Well, we need to realize that anything past this already got taken out. So the market, you can see it traded up higher past these highs. So really the market sees this high up here. This is the highest point in the last 60 bars.
Right.
It's this high up here. Now we do have, you can see we have a bullish fair value gap. Right, candles low, candles high. We have another one here. Just a bearish version. And then we have a bearish one here. So when we're here, and the market is existing right here, and it's 10 o'clock, it's 10:05 right now. But you got to remember, none of this exists yet, right? None of these candles have printed yet. We're only looking from this and left. So I don't know if it does it help for me to do it like this and just get rid of off the screen, or can you? Does not matter. Or can I keep these candles up for the time being?
Keep 'em up.
Okay. So yeah, so just remember that all of this is fake right now. So what does Pac-Man see from this red line? Well, he sees this fair value gap here, right? It's a bearish one. He sees this one up here also, and then he sees this high. That's all he sees. He sees 1, 2, and 3. Now again, we can apply the same premium discount thing we were doing earlier. So we know that if we're in the discount, we don't want to short, for one. That's the first thing. We want to be looking for longs. Now, if we're going to long, where can we long to? We can go for the inefficiencies and then the stop loss, maybe. You can pretty much guarantee you're going to go for the inefficiencies, but sometimes you won't hit the stop losses and you won't hit the true high, and that's okay. You can still make a very, very large move if you're getting 80, 90% of the range. Anyways, as we're moving up, we can see that it leaves a bullish fair value gap that can be used for more buying on the way up, and that's all fine and dandy. Here's where I got trapped. Just like how I was saying earlier that I repeated, if we're referencing old highs, in this case, to go for, if we're getting a setup in the opposite direction, so in this case a short, it should be fake. Because the market doesn't see these candles. It only sees these and these fair value gaps. So any short setup in this case should be fake, and you should not take it. Because the market doesn't see that. It doesn't see all the candles past this red line. It only sees the inefficiencies and this high. So I'll be sure to type it out to you, but if we're referencing old highs, any setup that we get that is for the short side should be fake. And this is how I fell into that trap, is I got a short setup on this order block and everything like that, even though it's a really crappy order block looking at it now. This is how I got trapped, and I went short. And you can see the market traded higher, and it stopped me out. Now, while I will say, you know, sometimes, like you said, you can just get unlucky and take a trade. But you also very, very much so want to just avoid bad trades. Like that trade I took should have never worked at all. It had no business working. From the moment I hit the button, it should not have worked. So that was the exact trap that I fell into. Is because we were referencing old highs. In this case, you know, the bearish fair value gap here and here, and then the old high at the very, very top. I lost a trade because I took a short referencing old highs. Because we should know that anything short side, anything, if we're referencing old highs, anything that is short should not work. It should be fake. It's going to just mess people up and get them stopped out and get them to short again when they don't need to be. And that was a trap I fell for. Because you need to remember, it can only look backwards. So all of these candles here are fake. So if you're referencing old highs, you need to, if you think about it, if you're referencing old highs, the market needs to go up to go to those areas. Because remember, it can't teleport. So if we're coming from here, and we got to get, say, this fair value gap here, and we're down here at A, and we're trying to get to C, we have to do some kind of bullish maneuver to get there. Right? You can't be bearish and go up. Bearish means you go down. So it's very, very crucial to recognize when you're looking back and everything like that, when you're looking for the inefficiency or anything like that that's targeted, you know that any kind of short setup you get is going to be fake, and it should not work because it's referencing to go up here. it's going to see this and go to fix it, like it did here. But any short setup like this, I should not have taken, because it was referencing these old highs. So if you're referencing highs, the shorts should be fake. If you're referencing lows, the longs should be fake. And that's how they trap a lot of people. A lot of people get trapped like this without realizing it. Even me. I mean, I literally just told you how I did. Now we can tie that back to the 4 hour we were just talking about. Same exact thing that we started in the very beginning. We're referencing these lows here when the week opened on this red line here. We're referencing these lows here. This is what the market is going to seek out. So we should understand that if we're referencing lows, if we're referring to old lows in the marketplace, anything that is long after you get, order blocks, CSD, which we'll talk about eventually, and, fair value gaps down, you should be trusting these bearish order. You should be trusting this bearish order flow. It should not just instantly flip bullish randomly for no reason. The market's never going to do that. This thing always and forever will operate on logic. We as people will stop using logic sometimes because of X, Y, and Z. But this thing runs perfectly 100% of the time, always. So it is always perfect, and it is never wrong. And so it will always do the correct thing, even if we don't. And that, like me on Friday, was a prime example. The market still did exactly what it was supposed to do and exactly what we're talking about today. I was the one that made the mistake. And that's the key difference. Just like when you eventually trade, you'll be the one that will make the mistake, not the market. The market will never be wrong, ever. You're at the mercy of it.
Right.
So, same idea. If we're referencing these lows and we get bearish signals, it's very, very likely that we're going to go seek out those lows in this case. And it's imperative to know that anything that we get long should not work. If that makes any kind of sense. It's kind of like three things put together. But if you're, I'm about to type it out for you. If we're referencing lows and you get bearish signals, like the order block FEG, the market should go for that low or that inefficiency, which either one, which you can make a very, very large portion of the move if you just go for the inefficiency still. You don't always have to take out the low, and sometimes you won't take out the low. You might retrace 90% of the range, and that can still make you a lot of money. Like, you don't have to be right, quote unquote, with the market. You really don't. You can be wrong well over 50% of the time and still make money. It's actually pretty cool when you do the math behind it. But we'll talk about risk management and everything like that eventually. But for right now, I'm just trying to teach you the logic of like how Pac-Man moves. Because if you can figure that out, well, then you don't need as large of a win rate as well, because if you're winning more than you're losing, that can help with the risk that you need also. So, but anyways, the market's going to go for, if it's referencing a low, it's going to go for that low or that inefficiency. So just like how we had those bullish fair value gaps there, it referenced those and then these lows. So it went for all three of them in this case. We had bearish signals, like here and here, to go for. So we also need to know the last thing is anything long in that case, since we're referencing lows, should be fake. And it's just going to act as extra, it's just basically just going to act as a trap for everybody else, is the idea behind it. Because what are people going to do? Because once you long something, what do? You put your stop loss. Once you enter the market, you put in a stop loss to protect yourself to get out, right? You're always going to do that. So when they're trapping people that are long here, what is everyone that's long doing? They're putting their stop loss. Where are they going to put it? Underneath here, here, and here. And then the market crushes it. That's on purpose. So this is probably the most common trap that I've seen. And this is really like the beginning of me kind of figuring it out more so. But once you understand that this is what it's doing and like how Pac-Man operates and like what he sees and not what the candlesticks see, because the candlesticks are just going to give us signals on where the market essentially is going to tip its hand and where it wants to go. But what the market actually sees and will reference versus what we will reference will always be different. We're going to try to get in sync with it as best as we can, but we'll never truly know what it sees because we'll have candlesticks on our screen. Now, of course, can we scribble over it and say, oh, this is invisible, all this is invisible, and it only sees, this? Absolutely. That's going to be the goal eventually, is whatever's balanced, you look past and you ignore it with your mind, and you don't use it as a reference point. You use the inefficiencies and the stop losses as reference points, is the idea. So, but same thing on the 5 minute, back to that whole speech. If we're referencing highs and we should get bullish signals. So for example, a bullish fair value gap, a bullish order block like this here. Like I was saying, when you compare or you combine like a order block and a fair value gap, it's a very, very strong combination, truthfully. So when you get stuff like that happening, or like here, bullish order block, completely held price perfectly. When you're getting that, you should know that anything short in this case should be fake. And I should have never taken that trade at all. At no point should I have taken that trade. And so that was the trap I fell into on Friday. And it's a very, very common trap that you can slip up on pretty often. And a lot of people don't realize it. Because you got to remember, this thing can only look backwards and it can only move forward. That's it. So anything, again, past that red line or whatever point that you're looking backwards from is fake. So one side of the market, or in this case, all the shorts that are past this red line are fake, and they should not work at all. So at the very, very least, you're going to either A, sit there and do nothing, or B, long. You're never going to short it. So at the very, very worst case, you're going to sit there and do nothing, which will save you money. And on the off chance you're going to only long, because you know that the market is referencing old highs. And that is the opposite of what I typed to you, because the 4 hour was doing the opposite. It was referencing lows, so you should know that any long setup should be fake. The 5 minute on Friday was a little bit different. We were referencing highs, so we know that every short should be fake. But again, this is on a 5 minute chart, because just like the market maker models and everything, all of this is fractal. The logic is always the same. The only difference is the time frame we're trading on. Like I said in the very, very beginning, we need that frequency in order to get the repetition for it. Just like in boxing, you're not going to get good throwing 10 punches at a bag. You're going to throw, 100, 150, 200 punches to practice it. It's the exact same thing. So we're going to get you're going to get the muscle memory and everything like that for it. So we're going to get that on the smaller time frames because they're going to happen so often. But if you want to slow it down to a 4 hour chart and, trade, twice a week, you can absolutely do that. But you won't have the repetition to have the proper skill to do so because it doesn't happen often enough. That's the only downside to it. So eventually you can move up to those higher time frames if you want. You can really trade, like I said, once or twice a month, once or twice a week, once or twice a day, whatever you want to do. But for right now, you just need the repetition and muscle memory is the big thing. So, and we're going to go one layer deeper, and we're going to do it again. So, we're going to clear this out. Actually, we're going to keep this here, just because. Now, exact same thing. We're going to do it again. But now we're going to look back from this candle. Realize that this bullish fair value gap here, you can see it gets filled. We have bullish fair value gap here. This candle fills it, and then it continues.
Right.
What happens after that? The market trades past it, trades completely past the fair value gap, and disregards it. So what happened? The first bullish PD array was disrespected. Now, you also get, what's cool, a bearish fair value gap on the way down. You get two signals immediately. once the high is in. And what happens above this high here? Buy side liquidity. Why? Because a lot of buy orders are going to flood the market when old highs are hit, because that's who smart money's trading with, right?
Right.
So you have all of those signals. You have like 3 different things to go for to signal that the market might want to turn around. Same thing on this 4-hour chart. Same exact thing. The market's trading up. You need to remember it's going to reference lows, like down in here. Maximize this for you. You're going to reference lows because we're looking back from here. This red line here in the middle. We're looking back at these lows. We get bearish signals. It's like a bearish fair value gap. Buy side liquidity gets taken. Because remember, the previous week's high was also taken. So we have buy side getting hit. We're referencing old lows. And we have a bearish signal now in terms of an order block and a fair value gap. So that we have the recipe for 3 things for a reversal, basically, on a 4-hour. And you can see how it goes for that low there. Right? Buy side liquidity, order block, fair value gap, bearish. And so we now know that anything that is long should be fake and we should not take it.
Right.
The exact same thing I've been yelling at you at for the last 30 minutes is happening. So now we're going to do it again on a 5-minute. So how we were long all of this before, now we're going to look back from here and we have the exact same signals. Bearish order block, bearish fair value gap, buy side liquidity hit, allowing smart money to do what? To enter. The liquidity getting hit, the buy side and the initial, is smart money entering. Now, I will tell you this. When we're here, we don't know that they're entering yet. We cannot tell that yet. There's no way for us to tell. What is important, though, is once you have that, and you pair that with a hand tip like this, or the market kind of giving its signal to you that, oh, it's going to want to change directions because now it's doing a bearish fair value gap. Because if you think about the elephant and how many orders smart money needs, they need a lot of orders, right? If you want 10,000 sells, what do you really need? You need 10,000 buy orders to come in to fill you, because otherwise you don't trade. And it goes back to like week 1 or week 2 that we were talking about. So when we're doing that and we're referencing from this red line here, and we have, again, those 3 signals, buy side liquidity, bearish fair value gap, bearish order block, change in state of delivery, formation, we can now use this area and look backwards. Now, if we're going to look backwards, we need to look at what are the inefficiencies in the market. So if we're going to use, so we can get rid of this one for now, and we'll do the exact same thing. We're going to look back from here, 60 bars. Because remember, you can look back from any bar you want. That's the amazing part about this and why this thing is so sick. You can look back from any candle you want. It doesn't matter. You can literally pick it. We can look back from this one or this one if you really want to, but I'm just picking this one because it's the high. So we need to look back at this. What is inefficient? If we're going to go through this whole price range here out of 60, so let's look at the highs first. Above in the last 60, so from here to here, red line to red line, what is the high? There's nothing. This is the highest point in the last 60 bars, is up here. So there's nothing above us to look at, to look backwards at. Because again, we're going to use logic to pair everything together always. This computer only operates off of logic, so that's what we need to operate off of as well. So what is happening? Now, all these fair value gaps, they're already filled, right? This one here, it gets filled on these couple candles next after here. The order block here is getting filled on these next couple candles here. The fair value gap that is here is getting filled on this candle here. So if you think about that paint stroke analogy, we have a large buy delivery here, buy side delivery. It fixes it and then continues. So what does that mean? It already did the paint stroke up initially on the fair value gap. It did the paint strokes down here. So now what? It's good. It's balanced. It doesn't see this anymore.
Right.
Order block, same exact thing. It trades into it multiple times here. That's filling it. It's balanced. It doesn't see it. Fair value gap here. Fills it with the sell side, because think of the pain analogy. Up on buy side, down on sell side, and fixes that price level. And then it does it again here, and then fixes that. So what is this? This is all balanced too. Bullish
Right.
fair value gap here. It trades through it here on these candles here. So yes, from this candle here, this red line, this was inefficient. Now, if we're being generous, it fills it immediately. So the one inefficiency that it had, it filled it already. So what is
Right.
Pac-Man looking at then? All he can look at is this low. Because he's going to see the inefficiencies and the stop losses. If there's no inefficiencies, what is it going to see? Just the stop loss. Same thing with our old, we'll run back to this right fast. When we were coming from this white line here and this reference point, we had these bearish fair value gaps, right, as reference points. So it had two inefficiencies to go for, and it filled them. And then it filled the high. Now there's no inefficiencies at all. There's none.
Right.
So what does the market really see? It doesn't see any of this. It sees none of this. We see it because we see candlesticks. It doesn't see any of this right now. All it sees in the last 60 bars, from this red line to this red line, all it sees is this low.
Is the market sentient? Because you said it. You said it sees.
It is not sentient. We'll talk about it at the end. But for right now, the only thing that what it really does is it needs to create reference points. Because you need to remember, people do what? They place their stop loss at certain levels that either books tell them to do, or they put it there because they want to. So the people that created this understand what the books tell people to do, and that's, on a breakout like above this high, you're taught to buy up here and put your stop loss underneath the low. So the market knows that, and that is what it'll use as a reference point, because they know that people put their stop losses there. It doesn't know how many people, it just knows that it puts a stop loss there. So it's not so much that it's sentient, but the market, just like Pac-Man, the only thing it's going to refer to is the old dots on the board he hasn't collected yet. That's all he's going to look at. Just like how he ran for these inefficiencies, he collected all the small dots that were here and here, and then he got the big dot up here with the stop losses.
Right.
Well, if all the big dots, or if all the small dots, are already filled, which we pointed out here, all the small dots are filled on the fair value gaps are already filled. There's nothing inefficient. So all that's left is the stop loss here. Now, the reason this is so key is because, just like the message I typed out to you, if we're referencing lows and we get bearish signals, the market should go for that low or the inefficiencies. Now, there's no inefficiencies, so there's only the low. What does that also mean? If we're referencing a low, the longs should be fake. If we're referencing a low, the longs should be fake. Because remember, everything after this red line doesn't exist yet. The market doesn't see these yet. Anything before this red line, it sees. Anything after, it does not see yet. It can only move forward. So any long setup you get in here, past this red line, we should expect it to be fake. This is the exact trap I fell for on Friday. I just did it the opposite direction. I went short when it was referencing highs, but now we're referencing lows, so the long should be fake.
Right.
So you can see, you get a reaction at the order block. It's closing that inefficiency out. It's getting rid of it. Now here's where people get trapped. Something like this. They're going to use this old order block and think, oh, this is going to hold, and you can see it starts to move up. What is that really doing, though? We know that anything past this red line, every long is fake. So what do we know to do? Either A, sit there, don't long it, or short it is a third option. We can short it. We just can either A, sit there, B, do not long it, or C, short it at that point in time. So you can narrow that down to really two options. You can either sit there or you can short it. Because we know that if we're referencing lows, anything past that red line, every long, if we're referencing a low, is fake. Every long, if we're referencing a low, should be fake. Because again, what does the market see? What does Pac-Man see? All he sees is this low down here. He does not see any of these candlesticks. Pac-Man is going to tip its hand and say, I want to go down here because we have a bearish fair value gap, bearish order block, all that stuff. So it's tipping its hand to smart money to say, hey, I want to go here. And that's fine and dandy. And that's the signal you're going to look for is that buy side, the order block, bearish fair value gap, and everything like that. And know that it's referencing this. So you have a very, very high probability of which side you should be on for the market maker model.
Right.
Because remember, they need to pair stop losses. So when they're up here and they're sell to open, what do they need to do? They need to buy to close to get out. They got to do the opposite. Where can they find sellers? They can find sellers underneath old lows. So when we're somewhere like here, we know that this long is fake. Or we should have a very, very high probability that this long is fake, and we should at the very, very least not touch it. Because again, same trap I fell on, this same exact trap I fell on Friday morning. This is that trap right here. You'd get trapped longing this.
Was that your first time getting trapped in that particular trap?
No. It's actually happened a lot more times. It happens a lot more than people realize. They just don't know that it's happening to them. Is really what it is. But no, it's not the first time.
Have you found out how to avoid it?
This is how you avoid it. You either A, don't trade it, or recognize that on one side of the market you should not be doing anything related to that at all. Now, the more advanced method, which I don't want to go into, could you theoretically on paper long this expecting it to fail? Yes, you can technically do that. That is a more advanced thing that you really shouldn't bother doing though. Because you know in the back of your mind, well, this long should already fail. Why would I even bother? I should just be shorting it. This was the same thing here. You can see how the short kind of got a reaction out of it.
Don't you get money if you long it and it does what you want it to do?
Yeah, if you long and it goes up, you will make money. Absolutely.
Have you ever longed it?
Oh yeah. Oh, I've long. Yeah. I was long from like 8:30 in the morning, basically, up to here. So I already did a long prior in that morning.
Today?
Did I what?
Today, like 8 this morning?
No, this is on Friday. The market's closed on Saturdays. This is all on Friday. All this data was from Friday from yesterday. So it was very, very recent data.
Yeah.
So, and that's the whole idea, and that's why I show such recent data that's how you know that what I'm talking about is more so legit in a way, because it's not like something super old from like 10 years ago. It literally happened yesterday. You know what I'm saying? It's like how could I be talking about something that happened yesterday that wouldn't be, like up to date. You have like a really old textbook from school and it's like 25 years old and you're like, this isn't even right anymore.
Yeah, and it's just ripped and destroyed.
Right. This is something that was written yesterday, so it's very, very recent, so you know that it's relevant data in that regard.
Yeah, because fresh, brand new.
Mm-hmm.
Latest.
So, correct. But yeah, the idea of getting trapped and everything like that is exactly what we're talking about right now, and how to avoid that. Is you got to remember this thing can only look backwards to move forward, and it can only seek out inefficiencies or stop losses. And again, when you're looking back from whatever line you can pick whatever line you want. It doesn't matter. Any
Right.
spot you want to look from. That's the beauty of this thing. You can look back anywhere. That is what it sees. Anything past that, you know that one side of the market, whether it's long or short, you should not even touch. You can touch when you're way, way advanced down the road, fine, I don't care. But for right now, absolutely not. So, like when we're past this red line here, we know that anything long should not work at all. How do we know that? Buy side taken, which in a vacuum is not going to tell us that. However, we get the signals right afterwards. We get the bearish fair value gap and bearish order block. So you have like 2, 3 things signaling to you that the market might want to turn around. Once you have that, then you'll look for the inefficiencies and where would the market want to go. Now, again, in this case, there's no inefficiencies. So it's just going to go for that low. But again, we know that this long here is absolutely fake and has no business holding. Could you have longed this if you wanted to be cool for like a little amount of points? Sure, but why would you want to do that? Like I said, that's way, way too advanced because you have to trade this expecting it to fail versus you can short this and expect it to work, if that makes sense.
Right.
Because you can only expect
Oh, yeah.
because you know that this high should not get touched. So you know
But if
that
it's most like if it's most likely to fail, then wouldn't it be good to do it?
I'll tell you in a second. Hang on. I got my parents calling me. All right, sorry about that. So with the whole idea of like I said, because you can long, like you could have longed this, but you need to expect that this high is not going to get taken. Is the big thing. So like, could you? Sure, but you need to recognize that in the back of your mind that this long is not going to go all the way up here. It's only going to go for like this bearish order block, which this technically is. Because the market is fractal. So you can find, long setups and short setups wherever you want to look, which is the dangerous part of like realizing that this is fractal and how, we're looking at a 5-minute chart and then we're looking at a 4-hour chart, but it's the exact same thing, even though I need you to realize that this is about 14 days of data right here. From here to here. This is 14 days. So about 2 full weeks of like 2 calendar weeks. This 5-minute was literally yesterday, but the logic is the same, and that's the key. That's what I need you to realize. Because yes, eventually, this 4-hour trade right here, this can absolutely be your day trade, and it was a total bullish up move on Friday, no question. 100% just a bullish move, and that was your day trade. But for the 4-hour, you had to recognize that, okay, well, that should have eventually failed, and it did. But for an intraday move, that's enough for you to form it something completely. But for right now, it's about recognizing the time frame that you're on and where you're at, and getting all that situated. So, back to the 5-minute. Yes, you could have longed this, but you need to recognize where you're going, and it's really not to go up to here. It's only to come up to some kind of inefficiency, like a fair value gap or an order block or anything like that. So, in the very beginning, you're just not even going to try it. And you're going to know that you can either A, sit there and do nothing, or B, short it. In this case. And not even worry about the longs, because you know that all the longs are fake because you're referencing this low. Is the whole thing behind it. Because remember, anything past this red line is fake. That is long is fake. So as it starts, and you can see, people that bought this, they got crushed immediately. With no remorse. Just trades up a little bit, crushes them. Hard. Right? And that's the trap. Same thing here. When I sold it. It worked a little bit. It's going to work. Crushes me. Why? Because it's referencing this high. So any short, if I'm referencing a high, should be fake. Any long, if I'm referencing a low, should be fake. And you can see it just crushes it all the way down to that low because that's all it sees is this low. You see what I'm saying?
Yeah.
Okay. So they've been pretty much going for a little bit over an hour. So we're probably going to roll out from this. I'm about to end this right now for us.